This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Thank you for joining me. It is Wednesday, November the 9th, 2016. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. This month I'd like to cover a range of linked topics shown here regarding what I see to be a situation of epic moral hazard. The concept of moral hazard has been with us a long time, and it is best thought of as the lack of incentive to guard against risk when one believes and acts if they are protected from its consequences. In economics, moral hazard occurs when one person takes more risks because someone else bears the cost of those risks. A moral hazard may occur where the actions of one party may change to the detriment of another after a financial transaction has taken place. I pointed out in 2012 in these graphics that the moral hazard associated with then current monetary policy could only lead to further unintended consequences and eventually completely dysfunctional markets. The U.S. equity markets have been a product of moral hazard since shortly after the financial crisis, when the central bankers began dramatically increasing their balance sheets and the monetary base. With the Federal Reserve consistently stepping in with a new program every time the market began to sputter, it wasn't long before the markets began investing as though the Fed had their back. Almost any basic economic analysis done in parallel with a weakening stock market gave you the timing required to make money. As you would expect, it didn't take long before corporations began to understand the opportunity and began increasing their debt loads by historically unprecedented levels of 20 to 30% year over year. But CEOs and CFOs didn't put the new debt into capital investment. Rather, they put it into buybacks of their stock and dividends for the shareholders. The correlation was soon evident to all and further added to the degree of overall moral hazard being experienced by the market. You will notice that recently that this incredible correlation, which I found when I was doing some research on the FRED system, the St. Louis Federal Reserve, which I found absolutely stunning, but you'll notice that it has began to falter here at the end. I believe the reason is because cash flows, that is EBITDA, and debt levels of corporations have reached a level that were potentially impacting their credit ratings. Again, as you would expect, corporations began to slow their rate of buybacks. Then, mysteriously, at the same time, we see the Swiss National Bank buying U.S. stocks to almost the exact level required to keep markets levitated. Obviously, nothing more than a coincidence, and certainly not something that anyone might suspect. They could potentially be acting as a proxy for the U.S. Federal Reserve or possibly the U.S. Treasury. Remember, this is exactly what the Bank of Japan is doing with the Japanese ETFs, and I've described that in previous reports. And the Fed has pretty well been following the Japanese playbook for quite some time. That is, quantitative easing, zero interest rates, and to some extent QQE. As I pointed out in the recent Under the Lens video, investors now believe that further policies are likely still ahead which will push returns higher, as the central bankers are trapped by the moral hazard they have created and inflicted on themselves. Here's a quote from a recent Reuters article And the headline was, Yellen says Fed purchases of stocks, corporate bonds could help in a downturn. And to quote the article, the Federal Reserve might be able to help the U.S. economy in a future downturn if it could buy stocks and corporate bonds, Fed Chairman Yellen said on Thursday. Speaking via video conference with bankers in Kansas City, Yellen said the issue was not a pressing one right now, but pointed out the U.S. Central Bank is currently barred by law from buying corporate assets. But the Fed's current toolkit might be insufficient in a downturn if it were to reach the limits in terms of purchasing safe assets like longer-term government bonds. And to quote directly from her, it could be useful to be able to intervene directly in assets where the prices have a more direct link to spending decisions, she said. End of quote from the Reuters article. This is why I put out this particular graphic about the central banks are trapped potentially in a Minsky melt-up, and you can see how it's been unfolding on them. Professional money managers have continuously witnessed the degree to which regulators would go to pass regulatory changes to keep the financial markets levitated, have come to expect that monetary and fiscal policy would guarantee their returns and remove the inherent risk. The leverage within the markets is now simply too great for policy setters to do anything else other than to protect investors, speculators, and frankly, gamblers. Though I have written about the fact I believe the central bankers cannot stop the business cycle and that the next U.S. recession will abruptly end this whole charade of false belief, I think we should appreciate where the likely explosion will first occur. Well-known Warren Buffett of Berkshire Hathaway made this statement in a 2000 annual report. To quote him, derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. As my friend Richard Duncan wrote in Corruption of Capitalism, after the financial crisis in 2009, and to quote him specifically, a quadrillion of anything must be dangerous. The global derivatives market grew in size from 10 trillion in 1990 to 760 trillion in June 2008, equal to the value of everything produced on Earth during the previous 20 years. If its growth had continued at that rate, it would have topped $1 quadrillion in 2010 and $1 quintillion, that is, add 3 more zeros, before 2020. Instead, the derivatives market imploded, triggering a systemic crisis throughout the world's financial industry. Derivatives are largely unregulated, and 90% of all transactions trade over the counter, unregulated. Forget about global warming. Our civilization is at a much greater risk of being wiped out by these financial instruments of mass destruction than by melting polar ice caps. Deregulation of the financial industry undermined the global economy by dismantling the safeguards put in place after the Great Depression. The derivatives market may be history's greatest Ponzi scheme. And again, I just quoted Richard Duncan. And I encourage you to check his work at Macro Watch, where he is actually doing a fairly exhaustive study on what's going on in over-the-counter derivatives. The Commodity Exchange Act of 1936 required that all futures and commodity options be regulated and traded on organized exchanges. The purpose of that law was to ensure transparency and to prevent the manipulation of commodity prices. In the late 1990s, the act came under attack. In November 1999, a report of the President's Working Group on Financial Markets recommended that the act be amended to allow derivatives to trade over the counter, that is, free from regulatory jurisdiction of the Commodity and Futures Trading Commission. The report, titled Over-the-Counter Derivatives Markets and the Commodity Exchange Act, was signed by Fed Chairman Alan Greenspan, Treasury Secretary Larry Summers, and Securities and Exchange Commission Chairman Arthur Levitt, and William Rayner, Chairman of the Commodities Future Trading Commission. I really hold them responsible for launching us on something that can be considered in no other fashion but extremely dangerous. Now, nearly 8 years after the global financial system came very close to being destroyed by out-of-control speculation in the unregulated derivatives market, there is still nearly $500 billion worth of derivatives trading in opaque, over-the-counter OTC markets. Some progress has been made, but it has been incredibly slow. The vast majority of all derivatives still do not trade through exchanges. Consequently, the continuing lack of transparency means there is still a real risk that derivatives are being used illegally to manipulate interest rates, currencies, and commodities. And I'm referring specifically, in case I haven't been clear to date, about the global swaps marketplace, where you can get the data from the Bank of International Settlements located in Basel, Switzerland, who are the only ones that keep track of this. Moreover, margin requirements are still not in force. Margins provide a buffer that reduce counterparty risks. The lack of margin increases the danger that the failure of one counterparty could spread contagion and result in systemic collapse, as near failure of AIG came close to doing, as you may recall, in 2008 with only things called credit default swaps, which at the time was in the 30 to 40 trillion. I believe that the credit cycle has turned, and I've written rather extensively about this for some time. I think it's time for investors to refocus on the banks who live via the credit cycle, and specifically the troubled EU banking sector. When the credit cycle turns, those banks most overextended always pay the piper. Problem banks are spread right across the Eurozone. Most in the financial media are presently focused on Deutsche Bank, as Angela Merkel currently claims they won't get bailed out. No doubt the markets will force her to change her mind, even if she was to stay in power in 2017. And I'm skeptical of that, frankly, from what I've seen from earlier regional and city elections. You can be assured, though, that Deutsche Bank will, in fact, get bailed out. It's some of the lesser well-known banks which are now, to me, the scariest. Some analysts expect another stock 600 bank index downleg of a similar magnitude to the initial downleg from last July into the February low. That decline equated to approximately 43%. Thus, a similar size decline from the recent high might bring prices down below the 90 level, or some 31% below current levels, approaching the all-time lows of about 79, shown here in this chart. Switzerland's Credit Suisse is one of them. The constituency to get them bailed out is not nearly as powerful. They're going to be a big problem, in my opinion. Or it could be Italy's Unicredit, or Spain's Banco Popular, which I recently posted on at Mata SII, whose demise could infect the bigger banks who hold humongous derivatives exposure. The election and other matters have put the massive problems at the banks on the back burner, and it has certainly helped to have a distracted rally in the banking shares since the September lows, but forgetting about them would be a mistake. They are about to become headline news again, regardless of the election outcome. Why? The credit markets are telling us this, and I think underneath it, it relates back to the discussion on OTC derivatives and the swaps markets. Banks are worried about something. Look at this 3-month Libor rate. The European benchmark cost of short-term borrowing for the international system has tripled this year to 0.88 as inflation worries are mounting. And matter of fact, they have spiked in the day after the Trump election quite dramatically. And bond prices have fallen dramatically. It's even worse than this chart is reflecting. The Libor rate is one of the few instruments left that still moves freely and is priced by market forces. It is effectively telling us the Fed is already 2 hikes behind the curve, and that's according to Saxo Bank. This is highly significant and is our number one concern. Our allocation model is now 100% in cash. This is a warning signal for the market, and it happens extremely rarely. Again, that's Steen Jacobson, head of the Saxo Bank, making that statement. Goldman Sachs estimates that up to 30% of all business loans in U.S. are priced off Libor contracts, as well as 20% of mortgages and most student loans. It is the anchor for a host of exotic markets. It's used as a floor for 90% of the 900 billion pool of leveraged loan markets, and I've written about that. It underpins the derivatives nexus, and the chain reaction from the Libor spike is global. The Bank for International Settlement warns that the rising cost of borrowing in dollar markets is transmitted almost instantly through the global credit system. The Libor OIS spread is near Eurozone debt crisis levels and past bouts of stress. Credit analysts are becoming nervous about the spread between Libor and the overnight index swap. Again, we're going back to the swaps, the so-called Libor OIS spread that is used to gauge problems in the plumbing of the credit system. It has widened to near levels seen in the Eurozone debt crisis, as I said, in past bouts of stress. The Libor is risky in the sense that the lending bank loans cash to the borrowing bank, and the OIS is stable in the sense that both counterparties only swap the floating rate of interest for the fixed rate of interest. The spread between the two is therefore a measure of how likely borrowing banks will default. That's why this is something you need to watch very, very closely. The Deutsche Bank problem has not gone away this easily by laying off another 10,000 people to reduce their employment by 20%. It has only been shoved from the headlines as U.S. elections dominate. It will soon be back with a vengeance because of its derivatives exposure as a result of these increasing interest rates I mentioned. As Jeff Goodlock recently explained, the market will keep pushing the price of Deutsche Bank lower until either it fails or is bailed out, according to him. Deutsche Bank is currently assessed as globally the most systemically important bank, a dubious honor to have. As J.P. Morgan also warns, and I quote them, "In our opinion, it is not so much funding issues, but rather derivatives exposure will be more likely to trouble markets going forward if Deutsche Bank concerns continue. This is especially true if these concerns propagate into a confidence crisis inducing more rapid unwinding of derivatives contracts." As we have detailed previously, Deutsche Bank has the world's largest so-called derivatives book. Its portfolio of financial contracts based on the value of other assets. As Forbes notes, it peaked at over 75 trillion, about 20 times the German GDP, but had shrunk to around 46 trillion by the end of last year. That's around 12% of the total notional value of derivatives outstanding worldwide, the 384 trillion, according to the Bank of International Settlements. As a reminder, if the liquidity run forces Deutsche Bank to start unwinding or being forced to novate derivatives, it could get ugly, and very seriously ugly. And I don't think any of the global powers to be know how to stop that. J.P. Morgan bank analysts confirm the size of Deutsche Bank's book and note that the Bank of International Settlement data provide an alternative but indirect way to gauge the size of derivative exposures. According to BIS, Bank of International data, the exposure of foreign banks to German counterparties via derivative contracts stood at 310 billion as of Q1 2016. Any problems at Deutsche Bank will immediately have broad-reaching impact. Even further hints of more problems might be enough to light a derivatives match here. We can expect the EU banking situation to turn chaotic after the U.S. elections as the December 4th Italian referendum looms, which heightens the worries within an already unstable Italian banking situation. The catalyst that I've talked about that is in front of us is the next business cycle recession. It is looming. It is there. That catalyst faces a fuse, and the fuse is that everyone is on the same side of the boat. The view may be best from one side of that boat, but it could easily and suddenly capsize because it simply wasn't designed for all the weight to be on one side, and that's where we are right now. A big part of that is because of this concept of passive investing. Active stock picking has been replaced by passive indexes and or ETF selections of baskets of assets. We are no longer stock pickers. We are buying these baskets. The problem with that is that the markets have become highly correlated, and now it is extremely difficult to find offsetting assets which allow people to hedge or to hedge effectively. The ETF market itself has a whole series of other issues which I won't get into here right now, but it's also centered out of custodial risk and having sufficient liquidity to adjust those ETFs at this individual stock level. We all know the problems associated with high frequency trading that could immediately allow this contagion to happen instantaneously. All have come to dominate in the 8 years since the 2008 financial crisis. They are untested, they are unstable, and have never seen volatility and stress conditions. Something is looming here. This is the fuse. The explosion, in my mind, is going to be the quadrillions of derivatives that have been pyramided associated with the swaps marketplace. But as I've always said, don't worry, they will print the money. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2016 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.